Hi, what I'm doing here is I'm looking at companies in the FTSE 350, so 350 largest UK companies, which gives me a degree of safety. It's a big assumption, of course, which are at multi-year lows. So you can see NatWest here is at the lowest it's been since, well, at least the last, well, almost 30 years, okay? Now, I'm looking to see, well, could it realistically go from where it is to maybe at least double? I'm not talking about going up to these kind of heady levels here, but with any of these companies, could it at least double? And what if that took 3 years? Well, if it took 3 years, I'd get a 33% return per annum, roughly. So that's not too bad. If it happens in a year, I'm laughing, but I'm willing to wait up to 3 years. The problem, of course, could be you can have multi-year lows like this, 189, it peaks, and actually that gives you double. And you can see why I'm looking at double and not looking at more and more. 150 goes up to 300, doubles, and then falls back. Now that's at 100. It's already got to 173. So you can easily see why it might go to 270 and drop back, or 200. So I'm not saying it's a foolproof strategy. So would I do this with NatWest? I'm not sure, because it's already dropped off the bottom after explaining all of that, and is around here, and I could see how it can drop back again. So let's look at some of the others. Lloyd's Banking Group. Would I do it with that? Probably a healthier company. Now, I did say this last year to my apprentices and students when it was at these closer levels to 27, and we're already at 41, so we're on track. What at 41? What kind of levels might I look at? Well, I think I really need to go to 80, because I need it now to double. Is that possible at some point in the next 3 years from price volatility alone? Yes, I think it is. BT Group, we are at the lowest we've been for 30 odd years. Do I think it go from 132? I mean, ideally we want it to be in at 100, but let's say 132 to 260 is what we're looking at. Now, can it do that in the next 3 years at some point just through volatility, and then you get the heck out of there? Is that possible in the next 3 years? Yeah, I think it is in the next 3 years on that one, especially when I consider broader financials, not just the price drop. Okay. I mean, in essence, I could make a portfolio of these where I'm expecting, mixed bag, some to reach that target, some not to. Future doesn't really fit the profile of what we're talking about. What about Capita? Capita is at the prices it first reached in 1997. You can see a problem with this strategy. Look at that. When it was at 80, it was at 1998 levels, and it went up to about 160, so it doubled, and then fell down again. So do not think this is by any means foolproof. 45, can it go back up to 90? Yes, it can. Why would I not wait any longer? Well, you've seen what happens if you wait too long. It drops back again. So I'm not willing to wait any longer. And you might say, well, but you could go from there up to those levels. Those are more normal. 400, a tenfold increase. That may be the case, but we'll see how it goes. Let's just get to double first. Okay, Capita, so I'm going to give that a yes. What about Hammerson? Yeah, same principle as what I've already said. It's at 34. Can it get me to about 70? Yeah, at some point in the next 3 years. Now, you might say, well, no. I need this Alpesh. It's been 3 months and it's not happened. So you all message me again in July, and I say, well, I didn't say 3 months, did I? I said 3 years. And when it happens, say in a month, you'll message me, Alpesh has doubled. What now? What now? So, well, I stick to my original strategy. I get the hell out of there. If you want to be risk-loving, then you take your original capital out and let the rest ride, because you're only riding profit, so you haven't lost anything. Okay, so that's the alternative way to look at it. What about Vesuvius? And remember, this is not my usual value, growth, income, cash flow, Sortino Alpha approach. This is a multi-year approach. Okay, so forget that one. Doesn't fit the profile. That doesn't fit the profile. Does that? Centrica? Yes, it does. 54, it's at 1997 levels. Can it get me up to 100? Should do. Remember the problem, even when it was at 68, we had multi-year lows, and it only went to 94 and then dropped again. Albeit it dropped because of the pandemic. Now, since the pandemic, it's gone up from 32 to 54. Will it go there? I'm going to give that a yes. Vodafone doesn't fit the profile so much. Aviva doesn't fit the profile. Provident Financial, yes, it fits the profile. Can it? Yeah, I think it could do it for us. Well, 260, no, it needs to go to 500. Yeah, it can. Doesn't fit the profile. Why doesn't this fit the profile? Well, it's been dragging around at these levels for years and years and years. all-time lows, pretty much all-time as in the last 30 years. Barclays, well, I'd mentioned this one as one of the ones from last year. 93, where are we? We're up to 160, 170-ish. I'm not going to now say from there, are we looking at 340? Because now we're having to push it higher and higher at some point in the next 3 years. Yes, I think in the next 3 years, it'll probably go to about 250, but I'd rather not. That's not big enough return for me. Pearson doesn't fit the profile. First group, 87 to 160 is what we'd look at. It's a bit of a problem. It's a bit more difficult. It's not clear cut. That's not clear cut. BP I'd already mentioned last year, and those of you who got in with me, and I'm still long on BP. We'd got in when oil prices were next to nothing, and I think it's about 230-ish. We're now at what, 320, and I'd need to wait still until we get closer to that 420 on that one. Okay, what else have we got? Marks and Spencers. Yes, can it go from 150 to 300? Yes, I believe so. 400 on HSBC. Now, again, that was one from last year where I said, look, I think I was on the BBC talking about this actually, 322. I said, look, your best strategy is I was on BBC with Sally talking about it, 320. I think it'll go to 720-ish at some point. So you get quite a bit of, what are you, there you go, there, you're about there. In terms of your returns. Kingfisher, no, doesn't fit the profile. Oxford Biomedica doesn't fit the profile. Sainsbury's, just like Marks, all getting kicked by little. 234, we need it to get to about a 500. That's a bit higher risk because that's a bigger ask. That's outside its normal range. And its range, well, it averages around 322. So if you took a volume-weighted average price of this, you're probably getting, or a price-weighted average of this, you're probably getting 322. We're at 240. So that's probably a bit riskier than I would want. Spirent doesn't fit the profile. Glaxo doesn't really fit the profile because it's pretty much at its long-term average. It skips around the levels it's at now. Sometimes it goes higher, sometimes it goes lower. So if you want to play higher, lower game, then yeah, you're fine, you know. But it's not the strategy we're talking about. So let's focus on what we're talking about. IAG doesn't fit the profile. Yes, if you want to play the bottom fishing game, which was something that's been at the lows, then you would have got in at 100 multi-year lows and expect to go to 200, which it has done. Okay, I think I'll leave that game now. National Express, as you'll know, was one of the ones we did, and it's gone up significantly. It's now, you know, roughly where it, you know, its long-term average is. Of course, it could go higher, it could go lower as well, so I'm going to leave that one. Shell is a similar story to BP. Okay, thank you very much.